Ever wonder how a global hotel powerhouse navigates a market with both soaring highs and, well, unexpected dips? Welcome to the Deep Dive, your express lane to understanding the real story behind the numbers. Today, we're tearing into Choice Hotels International's Q2 2025 earnings call, which happened back on August 6th.
Yeah, well, we'll be breaking down Choice Hotels' financial performance, looking at their pretty ambitious global expansion strategy, how they're navigating some tricky domestic market shifts,
Right.
and really what all of this means for their future trajectory. Our goal here is to give you a really comprehensive understanding, sort of the key takeaways from this important call. Think of it as your shortcut to being genuinely well-informed on Choice Hotels.
Exactly. We're going to start with a quick snapshot of those headline numbers, then really unpack the strategic moves that are defining their path forward, and dig into the underlying macro trends shaping the whole hospitality landscape. And yes, we'll even pitch a plausible, maybe slightly outrageous trade idea at the very end. So let's dive right in. So Choice Hotels delivered a quarter that, on the surface looked maybe a little mixed, but ultimately pointed to some underlying strength. They reported adjusted earnings per share of $1.92.
Right.
That actually beat consensus estimates by a couple of cents, which is a nice 4% increase year over year. And their GAAP EPS, that's generally accepted accounting principles, also surpassed expectations at $1.75. So strength even before adjustments.
And on the profitability front, adjusted EBITDA hit a Q2 record, $165.0 million. That's growing 2% year over year.
A record. Wow.
Yeah, and what's even more impressive, I think, is if you factor out a one-time $2 million operating guarantee payment they had related to managed hotels, well, that adjusted EBITDA growth actually jumps to 3%.
Okay.
Adjusted net income also saw a modest 1% year-over-year increase, reaching $89.8 million. So, yeah, solid performance there, despite some of the challenges.
However, not everything was pointing straight up. Revenue came in slightly below the FactSet consensus at $426.4 million. That marks a 2.1% year-over-year decrease. And a really key metric in the hotel world, domestic revenue per available room, or RevPAR, that also saw a 2.9% year-over-year decrease.
Which sounds a bit concerning at first glance.
It does, but it's important to note this dip was approximately 1.6% lower when you adjust for calendar shifts like Easter falling differently and the impact of that total solar eclipse we'd had.
Right. Those calendar quirks can really skew the numbers year over year. And despite that softness in the overall RevPAR, management was quick to highlight their outperformance in specific strategic segments.
Yeah.
Notably, their extended stay and economy transient hotels significantly outpaced their direct competitors. So showing some real targeted strength there.
And the market, it seems, kind of looked beyond those headline revenue dips. Shares reacted quite positively on the day of the earnings call. They opened at $121.49 and closed up at $124.65 on August 6th.
That's a decent jump for an earnings day.
Yeah, it reflects roughly a 2.6% increase from just before the call to the close, and it was accompanied by elevated trading volume. That really suggests, a cautiously optimistic sentiment from investors who are maybe seeing that bigger picture.
That's exactly it. And what's truly fascinating here is how Choice Hotels managed to achieve what they actually called record financial performance, despite facing some of those domestic headwinds we mentioned.
Right, the mixed signals.
Exactly. It really highlights the core strength of their asset-light business model, meaning they primarily franchise their brands, collect fees, rather than owning lots of expensive properties, which, combined with disciplined operations, is clearly shining through right now.
That focus on the asset-light model isn't just about their real estate footprint. It's clearly translating into operational efficiency, too. Specifically, we saw adjusted selling, general, and administrative, or SG&A, expenses.
These a key cost line.
Absolutely. They were down a healthy 4% year over year. And if you exclude that specific one-time $2 million managed hotel guarantee payment you mentioned, it was actually down 6%. This tells you they're laser focused on improving productivity and efficiency across the board.
And that operational discipline, it directly impacts their top line. Here's a key insight. Their domestic effective royalty rate increased by 8 basis points. That's 0.08% year over year to 5.12%.
Okay, so getting a slightly bigger slice.
Exactly. This isn't just a small bump. It's tangible proof that Choice's strategic shift to grow their portfolio with more revenue-intense brands is actively boosting their bottom line through higher fees per unit.
So let's unpack one of the biggest strategic moves this quarter, something that really caught our eye. the Canada acquisition. In July 2025, Choice Hotels acquired the remaining 50% interest in Choice Hotels Canada from their joint venture partner. Cost about $112 million.
Significant deal.
That's a pretty fundamental shift in how they operate there, isn't it?
It truly is. This move is significant because it transitions Canada from a master franchising model, where they kind of license the whole territory to one partner, to a fully direct franchising model. Management explained they prefer direct franchising in markets where, local small business owners can aggregate capital and where the regulatory environment is favorable for acquiring land.
Makes sense.
And direct franchising generally offers higher royalty rates and, crucially, more direct control over the brand experience, the standards, everything. Post-acquisition, Choice's international portfolio is now actually more direct franchising than master franchising overall. That's a big pivot.
So from Choice's perspective, what's the immediate upside they're expecting here in Canada? Is it purely about those higher royalty rates, or are there deeper strategic advantages in having that direct control?
Oh, it's definitely more than just rates. I mean, that helps. But with direct control, the Canadian team can now expand their product offering from the previous, I think it was 8 brands,
Right.
to the company's full portfolio of 22 brands, with the particular emphasis on those lucrative extended stay options.
Bring in the full arsenal.
Exactly. And the Canadian lodging market itself is projected to grow at over 5% annually, reaching over $50 billion in total revenues by 2030. So it's a big, growing market.
Wow.
This acquisition alone is expected to contribute approximately $18 million in EBITDA for the full year 2025. So it's definitely a growth story and a control story combined.
And it's not just Canada where they're making moves. Choice seems to be aggressively accelerating its international expansion everywhere.
Really are.
They extended a 20-year master franchise agreement down in Brazil, covering over 10,000 rooms. In France, they nearly tripled their room count through a partnership, adding approximately 4,000 rooms under direct franchise agreements. It almost feels like they're playing some high-stakes game of corporate monopoly, doesn't it? What's driving this rapid worldwide push?
Well, it's all about strategic footprint and capturing growing markets before competitors maybe get entrenched. They've also entered Poland with their very first franchise agreement there.
Poland, okay. New territory.
Yep. And in China, a huge market, obviously, they signed a master franchising agreement with a partner called SSOW, which is expected to add around 10,000 mid-scale rooms over the next 5 years.
10,000 rooms in China.
Plus, another strategic distribution agreement will add over 9,500 upscale rooms to their Ascend Hotel collection by the end of Q3 2025.
Okay, so from Brazil to Poland, France to China, Choice is truly planting flags globally. These international efforts are clearly building out their global pipeline, which now exceeds 93,000 rooms.
Which is a huge number.
An impressive 11% increase just since the start of this year alone.
And critically, 98% of these rooms in that pipeline are in those more revenue-intense brands. Think upscale or extended stay properties that typically command higher nightly rates and often longer stays.
Right, the higher value rooms.
Exactly. These are expected to generate significantly higher revenue and royalty rates, potentially with a RevPAR premium of more than 30% compared to their traditional economy base. This isn't just about adding rooms, it's about adding high-value rooms.
Turning back to the domestic market for a second, the extended stay segment continues to be a real standout performer for them. Their extended stay portfolio has grown over 20% in just the last 5 years to nearly 54,000 rooms.
Impressive growth.
And the segment's pipeline now accounts for half of their total domestic rooms pipeline. That's a huge commitment to that space.
Yeah, and the real takeaway from their extended stay performance, it's not just a growth story, it's also a resilience strategy. In volatile economic times, those longer average stays and more stable revenue streams make this segment a crucial anchor for their overall portfolio.
Makes sense.
And it's working. Their WoodSpring Suites brand was even ranked #1 in guest satisfaction among economy extended stay brands for the 3rd consecutive year by J.D. Power.
3rd year, wow.
Which translated directly into a fantastic 43% year-over-year increase in franchise agreements awarded for that brand. Success breeds success.
They're also doing something interesting in their economy transient segment, which, you might think is less glamorous. Management noted they are deliberately exiting underperforming hotels that just don't meet their brand standards anymore. How does letting go of hotels actually benefit them?
It's a calculated move, really. By shedding weaker properties, they essentially clear the way to open up those markets to new owners, maybe owners with more capital, and maximize the potential for more profitable hotels down the line.
Refreshing the stock.
Exactly. It leads to higher royalty revenue from new, better-performing contracts, and this operational discipline seems to be leading to results. Their economy transient hotels are actually outperforming the broader economy chain scale in domestic RevPAR and gaining share against competitors.
Okay, so it's working.
Yeah, their domestic economy transient rooms pipeline expanded by 8%, and they executed 42% more domestic franchise agreements in this segment in the first half of 2025 compared to last year. It's smart optimization.
And quickly on the upscale segment, global rooms there increased by 15% year over year to over 110,000 rooms, with nearly 29,000 upscale global rooms in the pipeline. And the Ascend Hotel Collection, that's their soft brand,
Right, for independent-minded hotels.
saw a 29% year-over-year increase in domestic franchise agreements awarded. So that strategic shift towards revenue-intense segments we keep talking about is really evident across the board, isn't it?
It absolutely is. These higher revenue-generating rooms now comprise a striking 88% of their domestic system. That's absolutely crucial for driving that effective royalty rate growth and boosting their overall profitability.
Management also highlighted how their guest strategy is tailored to address some key consumer trends right now, with, for example, lower gas prices and the fact that approximately 90% of their domestic portfolio is located within 1 mile of a highway.
Perfectly positioned.
They're really set up to capitalize on that growing preference for road trips and more affordable vacations. It's almost like they built their entire system for this exact moment.
And beyond just leisure travel, significant infrastructure investments happening across the country, driven by everything from Gen AI data centers to the reshoring of American manufacturing.
Right, that's a big theme.
That's fueling new business demand, especially for their extended stay hotels, which often cater to project-based work. This is reflected in their small and medium business, or SMB, revenues, which were up 13% year over year,
Solid.
and group travel business revenues, which surged by an impressive 48% year over year. That's a powerful combination of leisure and business driving demand.
And underpinning a lot of this is their loyalty program, Choice Privileges. That expanded to nearly 72 million members.
Huge number.
An 8% increase year over year, and it was recently named a top hotel rewards program by both U.S. News and World Report and Wallet Hub, so getting recognition there too.
Yeah, and the enhancements they've made to the rewards program are clearly driving stronger customer engagement. We saw evidence of that with a more than 40% year-over-year increase in the booking window for reward night redemptions in the first half of the year.
Meaning people are booking further out.
Exactly. That longer booking window helps them better predict and drive future occupancy for their properties, which is just invaluable for planning and revenue management.
And the final piece seems to be enrichment in technology, both for the franchisees, the hotel owners, and for the guests themselves.
Right, two sides of the coin.
Franchise-facing tools like advanced revenue optimization and profitability tools empower those owners, while things like a redesigned website, a better mobile app, and intelligent marketing initiatives enhance the guest experience.
And ultimately, it all contributes to long-term margin expansion and operating leverage for Choice. It's about efficiency and experience.
Okay, so a lot of positive strategic movement there. But while the Q2 performance showed significant strengths, particularly internationally and in those specific segments,
Yeah, the extended stay especially.
there were some adjustments to the full year 2025 outlook that you, our listener, should definitely pay attention to.
Right, so while we've heard a lot of strength, it's not entirely smooth sailing, especially looking ahead for the rest of the year.
Exactly. The full year 2025 GAAP EPS outlook was actually lowered slightly to a range of $5.54 to $5.86. However, importantly, the adjusted EPS outlook was maintained at $6.88 to $7.20.
Okay, so the underlying adjusted earnings power is still seen as intact.
Seems so. And the adjusted EBITDA outlook was also maintained at $615 million to $635 million.
The key revision, though, was to the domestic RevPAR growth outlook. That was adjusted down to a range of -3% to 0%, down from the previous range of -1% to +1%.
So a softening expectation there domestically.
Definitely. This reflects, as they put it, a more moderate U.S. lodging backdrop and ongoing macroeconomic uncertainty, particularly impacting those mid-scale and economy segments. They specifically called out headwinds from softer international inbound travel and government travel.
Management explained that the midpoint of this updated RevPAR guidance basically assumes the current trends they observed in Q2 will just continue for the remainder of the year. No big pickup expected.
Right, kind of flatlining from here.
And they also noted facing tougher comparisons in Q4 because of hurricane-related demand last year, which apparently provided a significant kind of one-off RevPAR lift that they won't have this year.
Yeah, those comps can be tricky. But looking longer term, beyond just 2025, Choice Hotels anticipates continued acceleration of international growth, particularly for their now 140,000 plus rooms outside the U.S.
That international scale is becoming really significant.
It is, and they expect to see even more growth contribution from the Radisson brands, which they acquired relatively recently, starting in maybe 2026, 2027, as they cycle through some initial integration churn. It's a testament to their long game.
And that Canada acquisition, which we dug into, is obviously a huge part of this long-term vision too, allowing them to expand from just 8 to their full portfolio of 22 brands and capture more market share in that Canadian lodging market, which is projected for significant growth.
Their overarching strategy really emphasizes growth from more revenue-intense hotels and markets, getting that robust, effective royalty rate growth, expanding partnership revenue streams, and just leveraging their enhanced scale. They also highlighted continued focus on strategic investments, and interestingly, the adoption of Gen AI to unlock even more growth and margin expansion down the road.
Gen AI popping up everywhere. Their capital allocation strategy seems pretty clear too, generating strong annual free cash flow, prioritizing value creation, and consistently returning excess cash to shareholders.
Yep. Classic shareholder-friendly playbook.
Year to date through June, they've already returned $137 million through cash dividends and share repurchases.
It's worth noting, though, that while Choice Hotels' total stock return over the last month, 3 months, and year has actually lagged some broader market indices and even sector-specific hotel ETFs.
Okay, so underperforming the market recently.
A bit. But crucially, their extended stay portfolio continues to outperform its peers on a RevPAR basis. This really demonstrates that resilience in what remains a challenging and somewhat uncertain environment for parts of the lodging sector.
Right, so segment strength isn't fully reflected in the stock price lately. Interesting divergence. Okay, and now for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, just like a hedge fund analyst might pitch to their investment committee.
All right, let's have some fun. Given Choice Hotels' strategic focus on that asset-light, fee-based model and their demonstrated ability to generate strong free cash flow and return capital, here's a thought for you to chew on.
Okay.
You could consider a long position in Choice Hotels. CHH is the ticker. Perhaps coupled with a short position in a, let's say, less agile, more asset-heavy hotel operator.
Like who?
Think about one that primarily relies on actually owning its properties, or maybe focuses heavily on full-service segments that are more exposed to those softer international inbound and government travel markets that Choice is seeing as a headwind too, but is maybe less insulated from.
Okay, so long choice, short and asset-heavy, potentially more exposed peer. What's the outrageous part?
The outrageous part. Betting on a continued, maybe even rapid divergence in performance. It's essentially a bet that Choice's strategic moves, like the divestitures of underperforming assets, the aggressive international push, especially into direct franchising markets like Canada.
Right, the things we've discussed.
That all this will allow them to significantly outgrow and expand margins relative to those more traditional players who still have significant exposure to the very headwinds. Choice is actively working to mitigate or offset. It's basically a bold bet on the power of that asset-light, fee-based model to generate superior shareholder returns, especially in a choppy market.
Got it. A divergence play based on business model and strategic execution. Okay, provocative. So let's wrap up this deep dive. Choice Hotels delivered a Q2 with record-adjusted EBITDA and EPS.
Yep, strong bottom line.
Largely driven by that aggressive international expansion, the pivotal strategic acquisition up in Canada, and the continued, really notable outperformance of their resilient extended stay and economy transient segments. While domestic RevPAR faces some headwinds, their focus on operational discipline, pruning the portfolio, and shifting towards those revenue-intense segments really seems to position them well for long-term growth.
Absolutely. But remember, everyone, the insights we shared here are purely for informational purposes. This is definitely not financial advice. It's crucial you do your own research, consider your own circumstances, and consult with a qualified financial professional before making any investment decisions.
Couldn't agree more. Thank you for joining us on this deep dive. We hope this exploration of Choice Hotels International's Q2 2025 earnings call has provided you with some valuable insights and hopefully a few genuine, aha moments.
And as you think about choice hotels and maybe the broader hospitality sector, here's a final thought to leave you with. What kind of disruptive innovations do you think could realistically arise from the wider adoption of Gen AI? How might that potentially alter the competitive landscape for all hospitality companies in the coming years?
Something to think about indeed. We appreciate you spending your time with us, and we look forward to our next deep dive.